Hello, I'm David Hardesty, and in this lecture we focus on the branch profits tax and branch interest tax that are imposed on foreign corporations with business profits in the United States. Foreign corporations that may be subject to the branch profits tax, earnings that are subject to the branch profits tax, investments in the United States that reduce income subject to the tax, the branch interest tax, and the impact of U.S. tax treaties on the branch profits tax. Here's an overview of the branch profits tax. The branch profits tax imposed by Section 884 is a 30% tax on the dividend equivalent amount for the tax year. The tax is imposed only on foreign corporations. The dividend equivalent amount is the foreign corporation's effectively connected earnings and profits for the taxable year, reduced by the amount of the increase in net equity during the year, and increased by the decrease in U.S. net equity during the year. Tax is also imposed on interest deducted in determining effectively connected income. This is known as the branch interest tax. The branch profits tax is not subject to withholding. The branch profits tax is in addition to the regular U.S. tax imposed on effectively connected income of a foreign corporation. And the tax can be reduced or eliminated by U.S. tax treaties. Here's an example of the calculation of the branch profits tax. At the end of 2008, Foreign Corp had $1,000 of U.S. net equity. At the end of 2009, it has $1,040 of U.S. net equity. The increase in assets invested in the United States is $40. The total effectively connected earnings and profits for 2009 is $100. The dividend equivalent amount is $100, less the increase in assets of $40 for a total of $60. The branch profits tax is 30% of $60 or $18. What is the purpose of this tax? The objective of the branch profits tax is to impose the same tax burden on a distribution from a U.S. business to a foreign corporation, regardless of whether the business operates using an unincorporated U.S. trade or business or a U.S. corporation. This objective is accomplished by taxing the earnings withdrawn from a U.S. trade or business by a foreign owner of that business, in the same way that dividends would be taxed when paid to foreign shareholders. In the example in the previous slides, if the U.S. operation was carried on through a domestic corporation, then the reduction in U.S. equity would be the result of a dividend distribution to foreign shareholders subject to U.S. tax. By taxing the net reduction in U.S. equity of the unincorporated U.S. branch, the branch profits tax imposes the same 30% tax on the reduction of U.S. equity. Accordingly, the branch profits tax is a substitute for the tax that would be imposed on a domestic corporation making dividend distributions to foreign persons. The following example illustrates the purpose of the branch profits tax. This example illustrates the manner in which the branch profits tax can substitute for the tax on dividends. Foreign Corp is a Country X corporation which owns several retail stores in the United States. The stores constitute a trade or business in the United States. Assume that in 2010, the U.S. business has earnings and profits of $1,500, and U.S. net equity increases by $100 as of the end of 2010. This means that $1,400 of profits were withdrawn from the business. This $1,400 withdrawal is subject to tax of $420. If the U.S. business was owned by a U.S. corporation, and $1,400 was withdrawn from that business and paid to Foreign Corp, that distribution would be subject to $420. To accomplish the purpose of taxing withdrawals from a U.S. operation in the same way, regardless of whether the operation is carried on through a branch or domestic corporation, we first calculate the dividend equivalent amount. The dividend equivalent amount is equal to the net assets deemed to be withdrawn from the U.S. business. In general, in any year that U.S. net equity does not increase, all effectively connected earnings and profits, or ECEP, for the year are deemed to have been withdrawn from the U.S. operations. If year-to-year equity decreases, then there is a deemed withdrawal of prior year earnings and profits, if any, in addition to current ECEP. And if there is a year-to-year increase in U.S. net equity, then the deemed withdrawal is less than current ECEP. Here's an example of the dividend equivalent amount. Foreign Corp, a Country X corporation, has U.S. net equity of $1,100 at the end of 2009 and $1,040 at the end of 2010. It has no ECEP for 2010. Its dividend equivalent amount for 2010 is $60. $1,100 beginning equity, 0 ECEP, and $1,040 of ending equity for $60 of dividend equivalent amount. Foreign Corp is deemed to have withdrawn $60 from its U.S. business, which results in a deemed distribution, dividend equivalent, to Foreign Corp. The key to the branch profits tax is the determination of ECEP, or effectively connected earnings and profits, and U.S. net equity. So let us first examine ECEP. ECEP refers to the earnings and profits determined under Section 312 of the Code that are attributable to effectively connected income. The calculation of ECEP starts with the foreign corporation's effectively connected income, the calculation of which we discussed in an earlier lecture. Then we make the same adjustments to this effectively connected income that we would make to a domestic corporation's taxable income if we were calculating that domestic corporation's earnings and profits. These adjustments are provided by Section 312 and will not be discussed here. As an exception to the Section 312 rules, ECEP does not include gain on the disposition of stock of a U.S. real property holding company. In addition, ECEP is not reduced by either the branch profits tax or the branch interest tax. Here's an example of the calculation of effectively connected earnings and profits. Foreign Corp is a Country X corporation with a U.S. trade or business. The company owns a tax-exempt municipal bond that is a U.S. asset as of the close of its 2010 tax year. The municipal bond gives rise in 2010 to effectively connected income. This is the case even though the income is excluded from gross income under Section 103A and is not gross income of a foreign corporation by reason of Section 882B. The income, therefore, gives rise to ECEP in 2010. A reduction in U.S. net equity can create a taxable dividend equivalent amount. However, this amount is limited to accumulated effectively connected earnings and profits, or ECEP, as of the end of the previous year. Accumulated ECEP as of the end of the previous year is the aggregate effectively connected earnings and profits for all preceding taxable years beginning after 1986, less the aggregate dividend equivalent amounts determined for such preceding taxable years. Here's an example of accumulated ECEP. Foreign Corp is a Country X corporation that operates a U.S. trade or business. It has $125 of effectively connected earnings and profits in 2010. Its U.S. net equity is $1,040 at the end of 2009 and $990 at the end of 2010. Based on this information, it has a nominal dividend equivalent amount of $175, which is the equity of $1,040 at the beginning of the year, plus the ECEP for the current year, less $990 of net equity at the end of the year. However, Foreign Corp's dividend equivalent amount is limited to its current ECEP plus its accumulated ECEP at the end of 2009 of $40. Accordingly, its dividend equivalent amount is $165. Here is how the accumulated effectively connected earnings and profits was calculated. Foreign Corp was formed in 2009 and had $100 of ECEP in that year. In addition, its dividend equivalent amount in 2009 was $60. Its accumulated ECEP at the end of 2009 equals ECEP less DEA, $100 less $60, or $40. Now let's turn to the determination of U.S. net equity. U.S. net equity is the sum of money and the adjusted basis of assets of the foreign corporation that are connected with the U.S. business, less the liabilities of the foreign corporation that are connected with the U.S. business. U.S. net equity cannot be less than zero. Let us discuss assets and liabilities connected to a U.S. business. In general, assets and liabilities connected with the U.S. business are those that generate the income and expenses that make up effectively connected income. The adjusted basis of an asset is its basis for purposes of computing effectively connected earnings and profits, which may differ from the basis used in calculating effectively connected income. An asset is excluded from U.S. net equity if one of the principal purposes for acquiring or using it is to artificially increase U.S. net equity. Likewise, if one of the principal purposes for repaying a debt is to artificially increase U.S. net equity, then that debt is added back to liabilities when equity is calculated. Here's an example of the calculation of U.S. net equity. Foreign Corp is a Country X corporation that is engaged in a U.S. trade or business. Foreign Corp owns equipment that is used in its manufacturing business in Country X and in the U.S. business. Depreciation on the equipment is apportioned 70% to the effectively connected income associated with the U.S. business and 30% to the income that is not effectively connected. Accordingly, 70% of the equipment is a U.S. asset. The equipment has an earnings and profits basis at the end of 2010 of $90. The amount of the equipment that is a U.S. asset as of the close of 2010 is therefore $63, 70% of $90. The regulations provide a special election to reduce liabilities, the purpose of which is to shelter accumulated effectively connected earnings and profits from branch profits tax. A foreign corporation can elect to reduce its U.S. liabilities by an amount that does not exceed the lesser of its U.S. liabilities or the reduction needed to reduce a dividend equivalent to zero. If the election is made, then interest expense on the liabilities deemed to be removed from the U.S. cannot be deducted when determining effectively connected income. Here's an example of the liability election. At the end of 2007, Foreign Corp has assets with a basis of $1,000 and liabilities of $800. At the end of 2008, it also has assets of $1,000 and $800 in liabilities. For 2008, it has effectively connected earnings and profits of $60, which it intends to retain in its U.S. business. Because U.S. net equity has not changed, there is a dividend equivalent amount of $60. Foreign Corp can elect to reduce its U.S. liabilities by $60 to $740, thus increasing its U.S. net equity by $60 as of the end of 2008 and eliminating the dividend equivalent amount. The cost of the election to Foreign Corp is the loss of interest deduction associated with the $60 of debt withdrawn from the U.S. business. A 30% branch interest tax is imposed on certain interest paid by an unincorporated U.S. business to a foreign person where that interest was deducted from effectively connected income. The purpose of the branch interest tax is to impose the same tax that would be imposed on a payment of interest by a U.S. business to a foreign debt holder, regardless of whether the business is incorporated or unincorporated.
Here's an overview of the branch interest tax.
Any interest paid by an unincorporated U.S. business of a foreign corporation is treated as paid by a U.S. corporation. Under the general rules applicable to non-business income, withholding may be required if this interest is paid to a foreign taxpayer unless one of the interest exceptions applies. In addition, if interest expense allocable to the branch's effectively connected income exceeds the amount of interest paid by the branch as determined above, then the excess is deemed to be interest paid to the foreign corporation by a wholly owned domestic corporation. Ordinarily, this can cause the deemed interest to be subject to withholding unless one of the interest exceptions applies. The sum of the actual payments and the deemed payments of interest should equal the amount of interest expense deducted by the branch in determining effectively connected income. Here's an example of the branch interest tax. Foreign Co. is a Country X corporation with a U.S. trade or business. It has $120 of interest allocated to effectively connected income. Foreign Corp's branch interest paid is as follows: $55 of portfolio interest paid to Jones, a non-resident alien, $25 of bond interest paid to Company C, a foreign corporation that owns 15% of Foreign Corp's stock, and $20 to Domestic Co., an unrelated U.S. corporation. No tax treaties apply. The interest payments made to Jones and Domestic Co. are not subject to tax or withholding on non-business income. The payment to Company C does not qualify for the portfolio interest exemption because C owns at least 10% of Foreign Corp's stock. It is subject to withholding of $7.50. This example is continued on the next slide. In addition, because Foreign Corp's interest allocated to effectively connected income of $120 exceeds its branch interest paid of $100, 55 plus 25 plus 20, Foreign Corp has excess interest of $20, which is treated as paid by a U.S. corporation to a foreign person and is therefore subject to tax of $6 under Section 881. U.S. income tax treaties can reduce or eliminate branch profits tax. Where the foreign corporation is a qualified resident of a foreign treaty country, then an income tax treaty can reduce the branch profits rate. The U.S. Model Treaty restricts the branch profits tax rate to 5%. In addition, a foreign corporation that is a resident of a country with which the United States has an income tax treaty is not subject to the branch profits tax at all if certain requirements are met. First, the treaty must provide an exemption from the branch profits tax. Then, the regulations require a person to be a qualified resident in order to obtain this benefit. The determination of a qualified resident is made under the regulations at 1.884-5. Here's an example of a treaty modification. Foreign Corp is a Country X corporation that derives effectively connected income from a U.S. branch operation. The U.S. Country X tax treaty exempts income not attributable to a permanent establishment. Foreign Corp does not have a permanent establishment and is therefore not subject to tax. However, the income nevertheless gives rise to effectively connected earnings and profits. The treaty specifies a branch profits tax rate of 5%, and if Foreign Corp is subject to the branch profits tax, then it is taxed at that rate. In addition, The treaty provides a complete exemption from the branch profits tax, and if Foreign Corp meets the requirements of the regulations, it is exempt from the branch profits tax entirely. In general, a foreign corporation is exempt from the branch profits tax in the year in which the corporation terminates all of its U.S. business operations. A foreign corporation is not subject to the branch profits tax for the taxable year in which it completely terminates all of its U.S. trade or business. The effect of this rule is to exempt a foreign corporation from branch profits tax even though its U.S. net equity decreases to zero, which would ordinarily create a dividend equivalent equal to the lesser of the decrease in equity or the prior year untaxed, effectively connected earnings and profits. The regulations provide various tests that must be met to determine if a company has terminated its U.S. business. Here's an example of branch profits tax exemption related to the termination of a business. Foreign Corp is a Country X corporation that has been engaged in a U.S. trade or business for a number of years. And as of the end of 2010, it terminates its U.S. business by removing all of its U.S. assets and liabilities from the United States and transferring them to Country X. Although its U.S. net equity has dropped to zero, it is not subject to branch profits tax. Additional special rules eliminate the branch profits tax when other circumstances work to reduce U.S. net equity to zero. The special rules are discussed in the text and in the regulations which avoid branch profits tax when U.S. net assets are reduced to zero. The level of detail associated with these rules is beyond the scope of this course. However, students should know that the rules exist. These special rules apply to a foreign corporation that temporarily suspends its U.S. operations, which has the effect of reducing U.S. assets, reorganizations and subsidiary to parent liquidations, which have the effect of reducing the branch's U.S. assets, the transfer of the assets of a U.S. branch operation to a U.S. corporation in a transaction subject to Section 351, and liquidations and reorganizations of domestic subsidiaries.